Okay, good morning to everybody. Today's Wednesday, week 12, and we're in the middle of talking about the content from chapter 15 dealing with budgeting. And we made a little bit of a dent on Monday, and we're going to sort of get into this a bit more today. One thing I will point out again, and I mentioned this on Monday, is that I moved the due dates for the homework quiz bonus to the 24th. This looks like a vacant week here. It's not really. I mean, we're going to be we'll have class. We'll talk about the rest of chapter 15. I'll probably get somewhere around the midpoint of the content of this chapter today in class. That's at least my goal. Then on Monday, I think we'll probably finish up most of the content. Maybe there's a fragment that'll be left over. And so my objective for next Wednesday, a week from today, would be to do some example problems and exercises from chapter 15. We're getting very close to the end here. I mean, it's already week 12, and we have this chapter to do, this module, and then chapter 17, which deals with standard costs and balanced scorecard. I have been alluding a little bit to balanced scorecard a bit as we've been going through some of this content, and hopefully that will sort of tie up a lot of the things that may be a little bit unclear at this point. So that's where we are. Any questions about anything? It doesn't look like we have anybody on the Zoom call just yet, so maybe we'll pick them up. One of the things I should say, and I was kind of thinking about this as I was sort of, oh, no, we have some people showing up. So as soon as I said that, we have some attendees. One of the things that I was thinking of as I was preparing for this is that some of the graphics I'm going to be showing may be a little bit hard to see on the video. But the good news is you can blow them up, hopefully, if you're able to do that, and in order to see them. Plus, there are mostly the same things like statements that are and intro statements that are in the text itself, in the PowerPoint package itself. Sometimes I move some of the PowerPoint slides around from the package that's sort of deposited in the Brightspace site. But just bear with me. And, for those of you who are watching on the video, which appears to be the majority of the class, at least you'll have the chance to, sort of blow it up and by blow it up, I mean simply make it bigger and be able to see what's going on. Okay. All right. So if there are no questions about anything, let's get into the discussion on where we left off last time. So remember, this entire module of the course deals with budgeting and everything connected with budgeting. And from a sort of an overview, I know budgeting itself, we have an entire course on budgeting, so it's not a simple process at all, and it's one that's got lots and lots of different variations. And companies have different styles. And as I mentioned on Monday, I think the emphasis that the textbook had on the participant budgeting as the bottom up, I think is really not the norm. It may be more aspirational. It may be what is hopefully the case in the future. I can tell you that right now that is probably not the way most budgeting happens. We see it sometimes in the tech industries where the people are really very close to the work to be done, or the ones who are most informed about what is possible. And the budget is really a sort of a statement of what is possible and what we're going to do. Remember, we go back to something we talked about on Monday, that the goals for budgeting are to achieve certain objectives that are achievable with difficulty. And I think that's really a key thing, is that we want our workers, we want our managers, we want everybody to work hard and to strive and to stress out over things, hopefully not too much. But we don't want it to be so easy that it's a layup. And by the way, one of the ramifications of having too easily achieved budgets is that the competition may not have that same point of view. And one of the things that I mentioned on Monday is that even though a lot of what we're doing in managerial accounting is internal reporting and documenting and all that, there is an external component to this, and that is communicating to the investment world, to the financial community, what we think we can do in the coming year or quarter or whatever, and both what we call the top line sales and bottom line net income. And if we don't achieve those goals, it's not a pretty picture. And so this is sort of a marriage of both the external and internal views. Okay, so it is important. And by the way, I talked to a friend of mine who is in budgeting for the IRS. And I know the IRS is a government agency, but he talked about they're doing their budgeting for next year. This is a government agency, According to him, they're under lots of stress right now, high stress. The dollar figures are gigantic and the stakes are high. And even though the government's not looking to make a profit, has no shareholders, there's a lot of stress on them. And I think that sort of reinforces, and I've kind of been out of the budgeting game for a while, but it kind of does bring back to me the idea that some of the numbers we'll be looking at are sort of scaled down just for easier viewing, but some of the numbers are just gigantic, in the billions, tens of billions, hundreds of billions in some cases. And so getting it right is an important thing. And this is why this idea of spending lots of time with careful and very well researched ideas makes a lot of sense. Okay. All right. So any questions before we get started here after I sort of laid the groundwork? All right, we talked a bit about this last time, and I don't want to go back too far, but I do want to sort of set the table for the idea of two categories, two classes of budgets, operating budgets, which is primarily what we're going to spend time in this course dealing with, which is really the idea of what are the income statement items that we need to be concerned about. These are things like sales, product costs, in other words, cost of goods sold, all the direct costs and indirect costs that go into making the product. So in other words, product costs. Direct labor, direct materials, manufacturing overhead, those are all income statement items. And this is as opposed to the financial budget, which is really more of a balance sheet issue. And as I mentioned on Monday, this really has got sort of an intersection between this and finance courses, where we get into a lot of this idea of capital expenditures and how we finance it, what the cost of capital is going to be after we do something, whether it's acquire a new business, spin a business off, buy a building, whatever. The cash budget, we'll get to the cash budget a little bit here, but we're not going to get as deeply into this as we are to this. And so that's really sort of the main goal. So once again, I want to go back to I really like this slide a lot because I think it's really illustrative of what's going on. This is sort of where we left off last time. We talked a bit about the sales budget, and one of the things that I mentioned, and it's just a fact, is that everything flows from the sales budget. Everything flows from the sales budget. So that's really the first thing that ought to be budgeted for, is what do we expect to be able to sell in the coming year. And again, I want to sort of emphasize a little bit of nuance here, that I know that sometimes the examples in our textbook are of one company that makes one particular product, or maybe two, and that's about it. What if you're a company that makes thousands of different products? Then they all have to be sort of aggregated and collated and formed into a rational sales budget, okay? And that's an important and a difficult thing to do sometimes. And again, we have this orientation in this course, like a lot of college accounting courses, of a manufacturing operation. And that's the direction we're going to sort of go. Again, as I've said a gazillion times before, that a lot of these concepts apply to service industries as well. So for the sales budget, if we know we think we're going to sell, and again, as I mentioned on Monday, a lot of this is also sometimes informed by the work of economists who are looking at what the industry itself is going to do. And industry does not refer to the firm, it refers to the entire competitive ecosystem in which all firms operate. And the question is, what is the entire industry going to do in the coming accounting period? And again, I think a year is an easier way to do budgeting than 5 years or 10 years. And so from there, we can look at our market share and say, this is where we think we're going to be. And then it flows to the production budget, which is based really upon units more than it is dollars. And we sort of bring the dollars in here under those three categories we've been talking about since day one: direct materials, direct labor, manufacturing overhead. And then we get to the non-product costs, the period costs of selling and administrative, which is sometimes a very big number, and we can compare a budget and income statement. But the thing to know is that operating budgets, all this is the operating budget, or budgets, plural. And then from there, we can put together things like the cash budget and capital expenditure budget, which allow us to prepare a balance sheet. We'll get to some of that a bit later, but that's really where we've sort of left off, okay? So I've gone backwards a little bit, but I think it's important for us to do it. So we've got some quick questions here, and won't take very long for us to sort of go through these. And so long range plan, number one, what shows potential sales by the industries and the company's expected share of such sales. And I think this would be a sales forecast, and it is. What is used as the basis for the preparation of the budgeted income statement. Well, that's part of the operating budget. So that's the that one category of budget. Number three, the blank is a set of interrelated budgets. And that's got to be the master budget. It's the master budget. And the master budget really isn't a budget at all. It's simply an aggregation, a collation of all budgets which lie subsidiary to it and which feed into it. Number four, blank identifies long-term goals. That's going to be long-range planning. And lower-level managers are more likely to receive results as fair and achievable under a participative budgeting approach. And I think that's probably right. I do express skepticism on this. And I've never really, up to this point, we're 12 weeks into the course, and I've really never challenged too much of the thinking in the textbook. But this is one that I do sort of push back a bit on, just because of the fact that I don't think the literature, the academic literature, supports this approach as much as what the authors may think that it does. And so, number six, blank, focus primarily on the cash resources. That's the cash, the financial budget. And it's really the cash budget is the answer, but the cash budget is a subset of the financial budget. So, and we'll get to a bit of that later. Cash budgeting is a really tricky bit of business. And I had some interface with corporate treasurers as my role as a banker, because those are people who really are tasked with managing the cash resources of a company. And it's not as easy a task as what you might think. All right, let's move to the second learning objective here. We're going to talk about these actual budgets. And again, these may not be easy to see on the presentation itself. I'll try to make it as visible as I can, but let's talk about the sales budget. So it's the first budget prepared, as we mentioned before, and everything flows from it. Every other budget depends on the sales budget. And if the sales budget is off, and I'm not talking off a little bit, I'm talking about off a significant amount, and pretty much everything else is going to be out of line, because the company has not achieved its revenue objectives. Sales and revenue being synonymous with one another. And it's an estimate, but it's not a guess. It should be based upon a combination of a lot of different things. And I know sometimes everybody likes to have easy answers to very complicated questions, and that's just not the way things work. Sometimes there are multiple answers and all kinds of different ways to get to the same result. And that's very unsettling. You can get the same result in different ways. So, which all adds to the complexity of the thing. So if the sales budget is really off by a lot, you're going to have a difficulty. Now, here's the thing. We're going to talk much more about this idea of variances. One of the things that we should have a very clear idea of going into this is the idea that budgets are always going to be a little bit wrong. The budget is a forecast, it's a roadmap, it's a game plan, if you like, and we're not going to hit all these numbers exactly on target. And what tends to happen is we can produce all kinds of internal reports based upon whatever kind of metrics we're interested in looking at, and they're going to really be trying to move the camera here. I'm having trouble; it's a little bit sluggish, and they're going to be sometimes difficult to assess. But we're going to have all kinds of different categories, things like sales and things like labor costs, and I'm sort of dropping down here, things like materials and whatnot. And you're going to have some actual figure and some budgeted figure, and I don't have much space here, and you're going to have some sort of variance. And the variance is going to happen. It's going to be a plus or minus, right? All the way down the line, you're going to have variances. And it would be extremely rare if you hit the budgeted target in every category for everything. And again, this looks like more of an income statement, and it really sort of is. Obviously, a very abbreviated one, not prepared in accordance with GAAP, but it's for internal reporting. We would probably, I've never seen a company report GAAP results that get into budgeting versus variance. Sometimes those, if they're big numbers on either the quote unquote top and bottom lines, then there's discussion about what those are about. But things like labor, materials, and whatnot, those are more internal items. But the variance is something that's going to be there. So even though, we talk a good game about the idea that variances, that we need to be as accurate as we possibly can, I think we also need to declare there are going to be variances. And how big those variances are going to be important. At the end of the day, we hope that we have net income at the bottom that has a positive variance. In other words, we have a beat on earnings. And that's really a lot of what the investors really like to see, is that we have met our expectations and have blown through them at times. And by the way, if we get to this idea of sandbagging, where we try to dumb down our objectives, then the financial community tends not to be impressed and says that, you know, you're guiding downward. We don't like that. And you know, Ford just a couple of weeks ago, when they reported quarterly earnings, they were sort of lowering their expectations, and the financial community didn't like that and made it very clear. And this is an unforgiving group of people, so you have to be prepared for lots of stakeholders who are involved. Okay. So in general, this is not terribly complicated. We take expected unit sales times the price of the product, price times quantity. But again, it's for all products produced. It's across the array. Simply price times quantity is always a revenue figure. Always, always, always. That is not particularly complicated. So we're going to get to this example that's going to be sort of a long-running example throughout this module. It deals with the Hayes Company. I think they make bicycles. I'm not sure about that, but I guess it doesn't really matter so much. But here's the preparation of that first budget, the sales budget, which we said is the primary budget from which everything else flows. The master budget is simply just the collection of all of these. So we're expecting sales volume of 3,000 units in the first quarter, with 500 unit increases in each succeeding quarter. So first quarter, which is January, so the year is December 31st. So we know we've got a fiscal year, a budget year that corresponds with the calendar year. So we know January 1st to March 31st, 3,000 units. And there's a 500 unit increase in each successive quarter. So if we add these up horizontally, we get 15,000 units throughout the year. And the sales price is $60 per unit. Again, this assumes one output unit, one SKU, in other words. 3,000 times 60 is 180 all the way across. So we get 900,000 in total budgeted revenue for the year. And again, we are hoping that that is achievable with difficulty. It's based on past experience. If the company did 200,000 last year and we're budgeting for 900,000 this year, it better have a good reason. And I'm not saying that never, ever happens. We have seen in the last few years, technology companies just grow by leaps and bounds, just unbelievable growth rates. And where that is the case, that is perfectly acceptable and very desirable among pretty much everybody involved, certainly the employees and shareholders and whatnot. But if it's a company that is maybe not growing quite as quickly in an industry that's not growing quite as quickly, making this number sort of jive with what is realistic is important. So from there, remember we go. So and I'm going to be flipping back continually to this particular graphic, which I really like a lot because it sort of talks about the flow of activity here, right? Sales budget begins first, then the production budget. So let's get to the production budget. So this is not so much dollar figures yet. We're going to get to it, but it's more about the units that are to be produced. Now remember, we've got a growth in output being forecast throughout the year. Whether this is realistic or not really depends upon what management's rational expectations are for what is expected. This is a pretty good growth rate in terms of units. But these fluctuations, these growth metrics are part of the budgeting process, what makes budgeting really, really difficult. So the production budget itself, which comes out of the sales budget and is dependent upon the sales budget, really meets a number of different purposes. Number one, it talks about what is it we expect to produce. Now, that's the end result of what this is going to be, but think about this. So it's a derivation from the sales budget, plus we want to add in an ending finished goods inventory. We don't want to get to an end of an accounting period where we have zero finished goods. So the numbers here are sort of a reworking of the ending inventory calculation, particularly in the case of a periodic inventory system. Right? Again, it's units, not dollars. The key value here is production units that are very akin to purchases in the merchandising realm. And I know that for all of us who took accounting 1, principles 1, we talked about this idea of production units. It's analogous to the idea of purchases. And what it is that we need to have throughout the accounting period. Okay, and so these are all unit numbers at this point. So let's think about what we got here. So we have expected sales units. We go back to I think it was 15,000 units for the accounting period. And we have some desired ending inventory because we don't want to end with zero ending inventory. Remember, no company wants zero inventory. Really, I mean, even though we talk a good game about zero-based inventory systems having very little inventory, it's really sort of an ideal where we have as little inventory as possible, because inventory, as I think I've mentioned many times, is problematic in the sense that it doesn't make you money. It actually costs you money to hold on to inventory. So we want to try to bring this down, but we don't want zero, really. We really don't want zero. And we want to take out the beginning finished goods because we are assuming that some of the goods we're going to be selling are goods that have already been produced. In other words, the prior period's ending inventory becomes the beginning inventory of the next period, right? That just goes back to what we talked about back in Principles 1, where we have one accounting period is over, we have ending inventory, and that starts the new process as the new motion picture begins. For the next year, we have beginning inventory for the next accounting period. So we are going to have some sales of goods that are on hand as we begin this accounting year. So to sort of take this in terms of numbers then, and again, I know this is maybe hard to see, and I apologize for that, but we try to do what we can. So we want to sort of work our way here, into, and I think I'm making this worse here, hold on. Oh, what did I do here? I definitely made it worse, didn't I? The production budget in terms of units. Okay, so, all right, so here we go. So, all right, so in the first quarter, again, we go back to what we talked about a second ago, where we have expected sales in the first quarter of 3,000 with a growth of 500 units per quarter as we progress throughout the year. And we expect future sales needs with an ending inventory of 20% of next quarter's, every successive quarter's sales. And so let's look at this and stop right here, okay? So we plan to have an ending inventory, because we haven't sold yet, of 20% of the next quarter's expected sales. So it's 700, which is 20% or 1/5 of 3,500 units. For the next quarter, we have to have some beginning inventory, because the ending inventory for one quarter, quarter one, is the beginning inventory for quarter two. So presumably, a lot of 700 of the 3,500 units are going to be sold out of production in the first quarter, right? And then it goes on and on. So 800 is 20% of 4,000, 900 is 20% of 4,500, and then 1,000, which we can only infer is 20% of 5,000, which is the next quarter of the next year, which we're not really dealing with here. But that's the idea, is that we want to have some ending inventory on hand. Whether 20% is sensible, maybe that's too high, I don't know, but that's what this company's policy is going to be. So think about this. We are producing, we're going to sell stuff, but some of it we're going to sell from existing inventory, and we're going to have some sort of desired ending inventory. So as a result, the production that is required, or the amount that's going to be required, which is not all production, but some of it's carried over, is 3,700. And then we're going to start with beginning finished goods, which we're just going to give it, which is 600. And by the way, where did 600 come from? It came from 20% of this quarter's sales. It was the amount left over from quarter four of, I guess, 2026 in this example. So these are already produced. We don't have to produce them. So the quantity that we need to produce is 3,100. So think about this. This is something that we need to really take a pause and look at, because if we're not really on board with this, and we don't want to gloss over this, you probably see these particular scenarios in the homework and quiz scenarios. We expect to sell 3,000 units, but we need to produce more than 3,000 in order to meet our needs, because number one, we want to have some available for sales for the next quarter, which are ramping up and ramping up and ramping up and ramping up. And they're actually, we produce more than what we expect to sell, because we are expecting to continue to grow sales out for the foreseeable future. The foreseeable future may be, I don't know how long it is, but it doesn't really matter. In this case, we've got 1 year of budgeting, and so we want to have 20% on hand for the next quarter's anticipated sales. And again, what if we don't make 3,500 units? Well, that's the way it is. I mean, If we don't, then we can make an adjustment. We can dial it down or ramp it up if we're able to do that. And this is why companies have slack in their production systems so that they can ramp it up if they need to. Dialing it down is no problem, usually. Ramping it up is subject to capacity. So 20%, 20% all the way across, okay? All right, so that's what but these are all units, okay? These are all units. And so a budget, though, has to get to dollar figures. And so we will get there here in just a second. So in this case, when we got this particular budget, we're looking at the direct materials. So we're going to be sort of given some information here about direct materials. And we're going to apply this then to those three product cost budgets that are a part of the broader category of operating budgets. And so in this case, what is the general formula? It's the number of units that we need to produce, which is not necessarily the units sold because they need to build up inventory and we carry some inventory over, times the direct materials units per unit produced. So how many units and whatever the materials are. Now these are different units. These are outputs and these are inputs, whatever they are. And there can be lots and lots of different inputs. And I want to try to make this as basic as we can because I don't want to get into thousands of different units. That's not going to really serve our purposes here. But these are output units times the materials that units of input is going to tell us how much of these direct materials we need to produce the desired output. Okay, and then we bring this down here. We sort of move this down. Required units of production plus again whatever the ending materials are minus the beginning because we didn't have to produce those; they were already on hand. Gives us the direct materials units to be purchased. And let's talk a bit about units of materials because this is an area that is a little bit unclear. But what are we really talking about here? We're talking about quantities of some input, whatever it is. And the measurement of these could be all kinds of different ways. They could be in terms, depending upon what the particular input units are. It could be pounds, it could be tons, it could be bushels. It could be board feet, it could be volume of liquid. It really is dependent upon what it is we're trying to make. It could be it could be the weight of something that we're making of plastic products or whatever. All these various inputs, and again the list goes on and on and on and on. It could be truckloads, it could be units of whatever. These could be distinct units in their own right? Maybe one unit goes with one unit. That's how we make our lives a little bit easier. But I know that sometimes where people get tripped up is the idea that we have direct materials and we have some uneven number like 3.4 or whatever. And students will often say, well, how do you have a fraction of a unit? Well, you can have a fraction of a unit for measuring tons or whatever. They don't have to be even integers, right? We can have fractional units. And so the point is that it really depends on what it is we're making. I think this company's making bicycles. That seems to be what I recollect here. But it doesn't really matter because what we're really trying to talk about here is more of a generic example of what it is that we need to purchase so that we can apply it to the production of the good. Again, this is a manufacturing sort of context here, okay? All right, let's go to the dollars because we need to get to the dollar figures here at some point. So if we go back to where we ended, which was here, direct materials units to be purchased for this particular upcoming accounting period, this is part of the budgeting process, we need to find out and apply the dollar figures that we expect to pay. So it's simply where we ended up on the last slide was one of the materials, again, we're moving into the product cost part of it, the production budget. Production budget is more units of output. It's not really bringing dollars in the picture yet. And we express accounting information primarily in terms of dollars. So we got materials to be purchased times the cost, gives us the cost of direct materials. And again, this goes back to something I've been saying as sort of a mantra for a long time. Whenever you have a unit in numbers, multiplied or divided by a dollar figure, you're always going to get a dollar figure. That's the Trump value. You're always going to get a dollar figure. So these are the costs of materials and just materials, not the other product costs just yet, but it's one piece of the picture. For us to produce the 15,000 units of whatever it is we're producing, which I think is bicycles. But if it's not bicycles, I'm going to stupid here. But I think that's what it is. So, all right, so let's get into it. Let's put the numbers together and get beyond the generic formula here. So we're going to say each unit produced requires 2 pounds of raw materials. Again, whatever the denomination of inputs are, pounds, tons, bushels, volume of something, whatever the case might be. In this case, it's pounds of raw materials at a cost of $4 per pound. Okay, so remember that 2 times 4. That's going to play a role here. For each unit of output, you're going to have 2 pounds of raw materials at a cost of $4 per pound. Where do these numbers come from? They're given. Okay, hopefully these are accurate numbers in the production process. What makes budgeting difficult at the moment, frankly, is the fact that prices have been rising across the board in the economy. And I know that a lot of people want to say that inflation is on the downturn. Well, it sort of is, but this makes budgeting really, really difficult when you don't know what the cost of inputs are going to be. This is why inflation, which is a general rise in overall prices, it makes life difficult because people don't really know how to budget when prices are moving upward. And even if you account for the upward shift in prices, how much of an upward shift do you account for? How do you know? It's difficult. This is why stable prices are sort of an objective. But companies are going to have to deal with the environment as it exists. They don't control the inflation rate. They have to deal with it. And but it does make life difficult from a budgeting standpoint. All right, for the first quarter, remember 3,100 units are to be produced, 3,000 units sold, but 3,100 to be produced. They maintain an ending inventory of raw materials, just the direct materials, of 10% of the next quarter's productions, and it's going to go along the same methodology that we use for ending inventory of finished goods. Here it's just going to be the raw materials piece of this, where we have to have some ending materials, which again, raw materials are part of inventory. They're not finished goods, but they're part of inventory. And we need to have some on hand as we keep going. So we need to understand that. And then we've also got some that we're probably inheriting over time in the desired ending inventory. So here we're given the dollar for the numbers. Desired ending inventory direct materials is 1,020 pounds for the fourth quarter. So that kind of gives us an end point. We can sort of work backwards from there. And then the charge here is to prepare the direct materials budget based upon, first of all, the sales budget, and then flowing from that, the production budget. Now we're kind of getting into the nitty gritty of the costs of production, input costs, right? So let's get to it. Let's talk about what this budget might look like. So this is a little bit tricky to look at. I understand that there's a lot going on here, and I know that if you're, hold on a second. And I know that if you're watching on the video, if you're watching on the video, it might be a little bit hard to see. So I'll try to blow it up as big as I can. So again, we go back to these units to be produced. That's the top line here. This is just the direct materials budget. This is not a financial statement. This is not something we would report out to the general public. This is not a GAAP prepared statement. It's not for external use. It's for internal use. Very often it's not to be circulated elsewhere. It's oftentimes controversial, but we go to this idea of 3,100, 3,600 all the way across. Again, we're producing more than what we're selling because we want some ending inventory of finished goods. These are the finished goods right here. But let's get to the direct materials. We said earlier, and I'm going to be sort of flipping around here because a lot of this is important. We said that we want to have, oops, wait a minute, 20%. Okay, we want to have some left. It's two direct materials units, whatever that is. And I think it's, where did I see that? I thought I had the right slide here. Oh, here it is. Yeah, it's right here. Okay. My notes were, I had wrong information in my notes. We said it requires 2 pounds of raw materials and a cost of $4 per pound. Okay. That's where that comes from. I knew I had it and I knew I referred to it, but I went back further when I had to. So 2 units of direct materials. And so as a result, if we're doing 3,100 units in quarter one times the 2 units of input, we need 6,200 units of raw materials, which are, I think, tons of something, right? Or pounds of something. All the way across, all the way across, all the way across. Okay, and then we want some sort of ending inventory so that we can have direct materials that we can carry over into previous quarters. We said 10% was the ending inventory, 10% of the next quarter's budgeted amount. So 720 is the amount of direct materials in pounds. I said tons a minute ago. It's pounds because it's 10% of that. And this is 10% of that, and this is 10% of that. In other words, the ending inventory is anticipatory as to what's needed for the next quarter. And so we want to have 10% on hand. Okay. So if we add these together, what we need to acquire, and plus what we need to hold on to, we get 6,920 pounds, 8,020 all the way across for all 4 quarters of the year. And knowing, of course, that we have inherited some from the beginning, and we had 620 and 720, which comes from there, 820, which comes from there, 920, which comes from there, right? These are carried over. We're just kind of look at this and sort of the flow is not all that tricky, but just know that we've acquired and already had on hand every quarter some carryover. 620 carried over from the 4th quarter of the previous year, then 720, all the way across, right? And so as a result of this, we have to take those out because they're already with us. We don't need to produce them. So as a result, we subtract 6920 minus 620, 6300 all the way across. And then we bring the dollar figures in. And this is really the last piece. We said it's $4 a pound for whatever these raw materials are. We're not told what these materials are. It doesn't really matter. It's quantity times price, quantity times price, quantity times price all the way across. So we had 1, 2, 3, 4 quarters horizontally added up. We get 124.8 just for direct materials. Okay, that's just the direct materials budget. And we're not even getting into labor yet. The labor piece we'll get to in a second, but if we go back to the sales budget, remember we had 900,000 in sales, okay? So remember that, that's the top line figure, what accountants call the top line. That's the amount of total dollar sales on the income statement. And I know we talk a lot about net sales versus gross sales. Let's not worry so much about returns and allowances and all that, which we get into later as we get to the income statement. But that's one comparison. So 900,000 sales, it costs us 124.8 just materials to produce that 900,000 sales. Okay, so that's something that's interesting. Okay, a little bit of a side note. One of the ways this chapter is organized is as we sort of approach the end of a module, we'll get into different examples here just to sort of give a bit of a flavor for different situations, different scenarios that might arise. In this case, we have a different company, it's Soriano Company. Welcome back to Hayes. Hayes is the main event. This is the side track here. So Soriano Company is preparing its budget for 2025. Relevant data pertaining to sales, production, direct materials are as follows. Sales for the year expected to be 1.2 million units, not dollars, units. Quarterly sales are, and I like this example because 20, 25, 30 to 25%. Now notice what's going on here. I think there is an idea that some people may have, and it's not necessarily accurate, that we can simply take annual data, divide it by 4 and get a quarterly figure, and that's supposed to be and that's maybe realistic. It's an average figure. Well, average isn't what we're looking for. We're looking for accuracy, and there is seasonality involved in lots of businesses. And I talked a bit about this on Monday, that if you're a ski resort, you're going to have most of your revenue in the first quarter of the year, assuming it's a calendar year, fiscal year, right? I mean, who's going to be skiing in August, right? It doesn't really make a lot of sense. So as a result, you're going to have you're going to have big humps and dips downward. If you're a company that is a retailer, for instance, retail companies oftentimes on a calendar year basis, they have lots of their sales in the fourth quarter because of holiday shopping. This is where that term Black Friday came from. Black is simply an accounting term meaning that we're positive in terms of net income, as opposed to red, which is negative net income. That's where the term Black Friday came from. Is the idea that retailers are finally going to get profitable after reduced revenue figures throughout the first 3 quarters. Okay, so this is an interesting presentation of the idea that companies have seasonality and that a lot of their revenue flows are not even at all. In fact, sometimes they're extremely lumpy to the point where some companies really dial down their activity tremendously when they don't have a lot of sales. If you're a hotel in, well, let's go with the ski example. You're a hotel in Taos, right? You're probably not selling many rooms in July, right? January, February, you're sold out. You know, that sort of thing. So seasonality is a big issue. The selling price is going to be $50 for the first 3 quarters and $55 beginning in the fourth quarter. What I like about this is also beyond the seasonality factor that's discussed here in this particular sales budget is the idea of pricing power and the idea that maybe at some point we'll have the opportunity to raise our price, to move our price around. A lot of companies have pricing power and they are always experimenting with prices to see what sticks, what doesn't. The example that I can't think of any more salient example of the airline industry. They are moving prices around all the time. It is really hard to know, and as somebody who's flown for lots and lots of years, it's really hard to know. I can't even predict. If I had to book a flight today to, I don't know, New York, I have no idea what I'd be expected to pay for it, you know? And by the way, whatever I pay today, it might be different than what I pay in 6 months from now. So to the extent that companies have pricing power, they can forecast any changes in unit prices, output prices to their customers, to the extent that they can make them stick and be supported by the sales and the units themselves. And so sales in the first quarter are expected to be 10% higher than budgeted sales for the first quarter of 2025. And that means that sales in the first quarter of 2023, and it might, I'm not sure what they're trying to say there, 2023 and 2025. I didn't notice that might be something of a typo. Doesn't matter. Let's kind of roll with it, right? So what we need to do is take this information given, and we are going to do a master budget. Again, the master budget is simply the collectivity and the collation of all those. So sales are expected to be 1.2 million units based upon this this distribution of revenue. Selling price $50 per unit. And again, by the way, 1.2 million units for the year, we can simply multiply by 0.2 or 20%, by 0.25, by 0.3 to get the sales figures for every quarter. And then those are units times the selling price of 50 for the first 3 quarters and 55 for the fourth quarter, and kind of roll from there. Okay, so that's kind of what we want to do to sort of build on this. And the budgeted data, and right now we've only gotten into direct materials. We're not going to get in yet to labor. We're going to get there. So management wants an ending finished goods inventory, 25% of the next quarter's budgeted sales volume. So remember what we've done here. Every end of the quarter, we want to have some targeted ending inventory. Because why? Because we need to have inventory on hand. We can't sell inventory we don't have. Even if it's a service business, we can't provide a service if we don't have the personnel and the facilities and the resources to be able to do something. So there's always a bit of carryover, and this is part of the trick of budgeting, is this idea of how much do we carry over. We don't want too little, we don't want too much, and so it's a balancing act. So as far as direct materials go, each unit requires 3 pounds of raw materials at a cost of $5. Management desires to maintain raw materials at 5% of the next quarter's production. We've seen that before, and we're assuming the production requirements for the first quarter are 810,000 pounds. Okay? And that's the first quarter of next year. Remember, we're talking about 2025, which is why I think we made a typo in the earlier slide referring to 2023. So remember, the first quarter of 20, and why is this information necessary? It's because we need to have some raw materials left over to become ending raw materials, which is an inventory account that becomes the beginning raw materials of the next quarter. One quarter's balance sheet data becomes the next quarter's beginning. So one quarter's ending balance sheet data becomes the next quarter's beginning figure. Okay. All right. So here's the sales budget, and again, we took that 1.2 million units, multiplied by those percentages, which differ throughout the accounting period. The big quarter is quarter 3. We have a unit selling price the first 3 quarters of 50, 50, 50, and we think we're going to sell at $55 in the fourth quarter. So simply price times quantity, price times quantity, price times quantity, price times quantity gives us dollar figures, which we can then add up to $61,500,000 in dollar sales for this particular year, and it's the entire sales budget for the year. Again, the key thing is to key off of the idea that the sales budget is the beginning phase of the analysis. Okay, so let's get to the direct materials piece of it. So here's what we've got. we've said that we want some ending finished goods that I believe is 25%. And let me see, where do we see that here? Yeah, 25%. We want ending finished goods at 25% of the next quarter's budgeted sales volume, which we've done here. And again, this is not income statement data, this is budget data. This is forecast data, right? These are not financial statements are backward looking, they're historical. This is forward looking. So 75% is 25% of 300,000, 90,000 is a quarter of, or 25% of 360, 75 is a quarter of 300,000. So as a result, we need to produce, we have the unit sales and we have the desired finished goods. So we need 315,000 on hand throughout the first quarter, second quarter, 390, et cetera, all the way across. Taking out the beginning finished goods, okay, which by the way, so the beginning finished goods are the previous quarter's ending finished goods. We're given 60,000 that carried over from quarter 4 of 2024. But notice this, 75,000 is the ending finished goods for quarter 1, which become the beginning finished goods for quarter 2. 90,000 is the ending finished goods for quarter 2, and becomes the beginning finished goods for quarter 3. 75,000 ending finished goods for quarter 3. No, right? That type of thing. So this is where this is why it takes a little bit of time to sort of scrutinize these. And so these are the units. And again, remember the production budget begins with units. And we haven't really applied dollar figures yet, but we're going to do that, right? And really the sales budget sometimes is the trickiest piece because we don't really know what we're going to sell. I say we as if we're running the company. It's not always known what's going to be sold. And so if you don't know what's going to be sold, how do you know what to produce? Again, this idea of slack in the production process is important. We got to this a little bit in chapter 14, where we said that the company's running it. In some examples, we had the company's running at 75% of capacity or 80% of capacity. It might look like they're not utilizing their resources, but this idea of slack is important to be able to handle not only special orders, but unexpected increases in volumes. All right, so we had the units here. Let's put these to dollars. So we had units to be produced. They cost were $3 per unit all the way across. And so these are the total pounds. I'm sorry, not total cost. These were these 3 units of whatever the direct materials was. I think it was pounds, yeah. So 765, 945. This is just this times this all the way across. And we had some ending amount here, which was a percentage. 5%, I believe, was the amount of ending direct materials that we carry over. So we add those up because we need to build in that excess. And so we have 812, 996 all the way across. Subtracting out the beginning amount of raw materials all the way across, subtract, gives us that. And we said that the cost per pound of this one input material, just materials, fortunately it's only one distinct material. It's $5. 774 times 5 is 3,870,000 all the way across. We add these up, we get 18,101,250. That is the cost that we budgeted for direct materials for this coming year. So again, going back to the idea, this is not the Hayes example. This is the Soriano 61,500,000 sales top line number, and we get to 18 million just for direct materials. Is this high? Is it low? I don't know. I mean, it depends upon the industry. It depends on what peers are doing. This is why companies look at what other companies are doing in their industry to find out what they might be doing better and how they might improve. But it's a good thing that the materials costs are low than the output prices. That would be a serious problem because we haven't even gotten to the other costs like direct labor. We haven't gotten to overhead yet. We haven't gotten to administrative costs yet. So there are more costs to come in both examples as we are working our way down to the final net income figure, which is what's budgeted. So we get the top line sales for both these examples. We're going to work our way down to the bottom line, and then next week we'll get into more of the issue of building the balance sheet. But right now we're really talking more about income statement items. So what have we gotten to at this point? We've got the sales, net budget, the production budget, but just in the context of direct materials, What's next, right? Direct labor and manufacturing overhead. Remember, 3 product costs, categories of product costs: direct materials, direct labor, manufacturing overhead. We're going to get to those. And then we're going to get to selling administrative expenses, which are non-product costs. These are period costs. These are things like salaries of non-production personnel, depreciation on the headquarters, insurance expense on the various buildings, advertising, shipping, sales commissions, all these costs which do not apply to the product itself. And then we will finally get to the budgeted income statement, which is our roadmap for profitability. And nothing is more important than profitability for companies. I know there are all kinds of other subsidiary pressures about producing safe products and sustainable, environmentally safe products. And that is true, and it's actually whether companies want to do that or not, sort of being forced on them. But at the end of the day, profitability is, I don't think there's any debate about it. It's the most important factor, okay? Regardless of of the pressures that are sort of being placed on companies, and they are, okay? So we talked about direct materials as one product cost category. What about direct labor? So basically, this is not all that difficult, really. And I've long been communicated to the class, and I think direct labor is usually the easiest piece of the puzzle, because it's, number one, we've been long involved in collecting very accurate payroll data. And by the way, if our payroll data is not accurate, it's usually the workers themselves who say, hey, it's wrong. And so, most workers are very attuned to what they've worked, how much they're earning, and why not? That's their business, right? So we're taking the quantity of hours and the cost of labor to meet the production requirements. And this is interesting here. It talks about maintaining a labor force that can meet expected production. And again, I talk about this thing called slack, that we don't want the labor force to be so thin that we are unable to meet our existing sales obligations, our existing production and sales obligations. Because what happens then? Then we have to go get labor. We have to pay extra for it. We have to get temporary labor and pay way more usually than the prevailing wage of employees sometimes. Or we have to pay overtime. And a lot of companies don't want to pay overtime. A lot of companies do not. If somebody's earning $20 per hour, they don't want to pay them $30 per hour simply because they don't have enough labor. So slack is an important issue here. You want to have enough labor force that can meet existing obligations. You don't want too many workers. Nobody wants that from the supply side view of things. But you don't want too little either. And so it's again, as in the case of direct materials, it is a delicate balancing act. And by the way, it's not just a one-shot thing where we're stuck with the budget that we do in October, November, the fall for the next year. These numbers can all be adjusted. We can say, hey, we were a little bit wrong on labor. We're gonna have to do something different. Or we were a little bit wrong on direct materials. The idea of flexible budgeting, I think, is something that's very appealing, and I think personally is a more realistic way of dealing with it. So again, we talk about units to be produced times the direct labor hours per unit, and the cost per hour is direct labor cost. All right, there's one big glaring, what's the one big glaring factor that just sort of sticks out here, like a sore thumb? What are we assuming here that should be a cause to say, well, we gotta drill down a little bit deeper? What is that? One of these factors here, labor cost. Because it assumes what? Right. Workers don't all make the same wage, do they? Sometimes these wages differ dramatically based upon seniority, based upon skill level, based upon job grade. And sometimes workers themselves don't even know what other workers make. Working right next to them. And I know a lot of companies will try to tell workers, don't tell anybody else what you earn and whatnot. And I'm not sure that always works very well. But workers don't make the same wage. They just don't. And so this complicates things a little bit. Now, I don't want to over dramatize the differences here, but we've got to probably take into account the fact that labor costs are not uniform. In fact, they can vary pretty wildly. And a lot of it has to do with seniority in the workforce. One other issue we should talk about is in some places where unionization is a big factor in workforce I guess, labor force organization. You have sometimes what are called open shops where you can have unionized workers and sometimes workers who aren't part of the union because they choose not to join. CNN is one of those. We can join the union or not join the union. We can be working hand in hand against with people who are not in the union. But in that case, we may have different wage rates altogether. And so these differ. So I think this is part of the picture here. I don't mean to overly complicate our lives here by talking about the fact this is wildly variable. But the idea is that if we are able to maybe arrive at some sort of blended, sort of weighted average labor cost per hour that can apply across the workforce and apply that to labor costs, just direct labor is the one category of product cost that may work. I think also that sometimes the labor budget is very much informed by HR. And again, to the extent that budgeting is done in a way that involves lots of participation from other areas, sometimes HR has a better grasp on what costs should be. Bigger companies will have usually a compensation manager whose job is to find out what it is we're paying people. Is it competitive? Should it go up? Cutting wages is always a tough thing, but raising wages is something the compensation manager might deal with. And again, to add one more complicating factor is labor costs is not just hourly wages. It's also benefits, it's payroll tax. It's all these things which go into it, sometimes which are very significant indeed. But the general concept is this. If you want to tie labor cost to production, you're finding out what it is we're producing. We're going to go back to the Hayes Company example, which is the sort of the main road here, times the number of hours required per unit to make this unit of output and the labor cost, again, which should probably be more of a blended figure. And we get some total big dollar figure called total labor cost. Now, by the way, this is a manufacturing example. Both examples are manufacturing. But in service companies, labor cost is the most important cost by far. No question about it. I mean, I can't think of too many service industries in which materials are that expensive or even overhead. I mean, if you look at where the economy is going, more of a high-tech economy where, we've got equipment and whatnot, but it pales in terms of what we compensate employees for in the technology area, and software and networking and application producing, those sorts of things. And so labor is a big part of the picture. And here in the manufacturing context, it's only one of the three categories of cost. So in this case, we're going back to the Hayes Company. Remember, we go back to the production budget. These are the units to be produced, 3,100, 3,600 all the way across, 15,000 units for the year. It takes 2 hours of labor per unit of output. So we have 6,200 units of labor hours, in other words, units of labor being expressed as labor hours across the board at $10 per hour. Again, that's sort of a wild assumption. Everyone earns $10 per hour. By the way, you can tell how outdated this is because that's not even minimum wage here in this particular area. So multiply price times quantity, price being wage, times quantity all the way across, and you get 308,000 for direct labor. Now again, direct labor is a product cost. It's the labor piece that attaches itself to the cost of inventory. This does not include the salaries of the CEO and the CFO and HR people and legal staff and all that, accounting staff generally. These are the wages for people who are involved in producing the product. And they tend to go up and down with the level of production. So these are really variable costs in many ways, as opposed to some of these salaried personnel whose costs really are considered more to be fixed in nature. Okay. All right. So we've talked about direct materials, direct labor. So now we have, this is the 308,000 as the direct labor budget for this company. And this is the Hayes Company example that we're talking about here. So at this point, we go back to the production budget. That's where we arrived at those numbers, and we got our way down to the production, the labor cost based upon those numbers. Okay, so again, and the production budget flows to the sales budget. Okay, now let's move on to the final category here. We've got about 13 minutes. I think we have time to get to where we want to go here. And that's the last category of product cost, that's manufacturing overhead. And so this is an estimate. Now remember, what I think is really interesting about this is the idea that we talked and have really talked from the very beginning of this course about manufacturing overhead. And we oftentimes say, okay, however we apply overhead to product cost, because we know it's a product cost, if it's truly overhead related to production, and we've got all these different methods. We can just simply take total overhead cost divided by total units and absorb it that way. And that's got some limitations because not all outputs have the same overhead application. So we have activity-based costing as one method of doing that, okay? But we've been talking about the complicating factors that overhead presents because of the fact that among the product cost categories, this is indirect, whereas direct materials and direct labor are direct costs, hence the name direct. Here it's indirect, and so we have to figure out what to do with overhead costs. But this is where, and I said before, back when we talked about activity-based costing, that we are given a figure. So we say $5 million is the manufacturing overhead for the next year. Where does it come from? Well, it comes from the budgeting process. And the budgeting process is influenced a lot by historical experience, by the building in of current and future expectations. It's based upon some realistic estimates. And from there, we divide it up and divvy it up to product cost in ways that make sense. And we got into a little bit in the last segment about talking about the difference between fixed and variable overhead. And prior to that, we really hadn't gotten into fixed and variable, but overhead can be fixed and it can be variable. And the examples of fixed overhead will be things, I mean, salaries sort of loom large, production salaries, production supervisor salaries, inspector salaries, depreciation on the building, which is fixed, on the production building, that is. Those are all things, that are directly tied to it. Interest on financing of equipment, these things are relatively fixed. That is, they don't vary with the level of output. That's really the differentiating factor between fixed and variable. So in this example, Hayes Company expects variable costs to fluctuate with production volume, which is not a particularly unusual statement, but it's based on the following rates per direct labor. So what does that tell us? It's a traditional approach. So we're simply saying, okay, we're going to absorb overhead into product costs based upon labor hours. And we say it's a traditional approach. I was hopefully, fairly explicit in this discussion when we talked about ABC costing, saying there's really nothing wrong at all with direct labor hours if labor hours are particularly relevant. And in some industries, they definitely are, certainly in service industries. But this is a manufacturing operation, and maybe that's not incorrect either. So the traditional approach usually takes labor hours or labor dollars, which is simply different ways of expressing the same variable. So based upon these rates, indirect materials $1 per unit, right? Indirect labor $1.40 per unit, utilities 40 cents, maintenance 20 cents on a per unit basis for 6,200 direct labor hours to produce 3,100 units. Remember, it takes 2 hours to produce 1 unit of output. 1 labor hour to produce 1 unit. I'm sorry, 2 labor hours to produce 1 unit of output. So 3,100 output units requires 6,200 direct labor hours. Twice the 2 times 2 hours for each output unit. And so indirect materials are going to be what? Well, all right. So if it's going to be 6,200 labor hours, that's the driver, right? The pool is the idea of labor cost, right? That we're simply putting overhead into, but there's going to be a driver. There's going to be something that we can track and therefore drop onto overhead costs on product costs. And so we're saying it's direct labor hours. It's twice the output level, 3,100 units in the first quarter, times 2, 6,200. And we already given the rates that have been applied in the budgeting process. Indirect materials $1, so 6,200 labor hours times $1, $6,200. Indirect labor $1.40, so that's 6,200 unit labor hours times $1.40 is $86.80, and on and on. And we'll get to the utilities, though. We'll show that a bit later. They've kind of abbreviated this discussion. And we also recognize that some maintenance is fixed, so not all of it is tied to overhead or tied to production. And And then there are a lot of maintenance costs that are fixed because of maintenance employees who receive salaries, but that is they don't vary with output level. And then we're going to assume all the fixed costs are assumed, and the fixed costs are easy peasy in this example. I think you'll find this is not a overly complicated as it relates to fixed costs. The fixed overhead cost, that is, variable overhead costs are a little bit more trickier, but not really. And I know this looks. Let me kind of expand this a little bit if I can. This looks. The bark is worse than its bite. I will assure you. The direct labor hours again are based upon units of production going back to the production budget all the way across times 2. So you get 30,800 units of labor necessary. And now we're only covering overhead here. And we're going to break that into 2 categories, variable and fixed. Now, let's talk, the fixed are easy. Let's just do the easy part first, okay? These are all the same, 20,000, 20,000, all the way across, boom, 30 all the way across. This is what fixed costs are. They don't change in the short run. And that's really the assumption behind what fixed costs are. Now, this is maybe overly fixed. I mean, they're saying there's no change at all. And that may be maybe an oversimplification, but in this case, it does make our lives simple. They are trying to hammer home the idea these costs are not changing, regardless of these fluctuations in production activity throughout the year. But these are not going to change. We're stuck with these. And in the long run, we said all costs are variable. But in the short run, which I think definitely a year budgeting would qualify as, these are not changing. So that's easy. And all we do is add these categories up, boom, and across. And we'll eventually add variable and fixed together to get so 18,600 to 38,557 all the way across. But let's go to the variable because this is where we came from. So the variable costs, these do fluctuate with level of activity. And we said it's $1 per hour for labor hour being the driver for overhead here on the traditional approach, 6,200, 72, all the way across. That's easy. Indirect labor, $1.40. It's basically $1.40 times this. $1.40 times this is this, and this all the way across. And then we get into the utilities, 40 cents. This is why I said utilities will come a bit later. 40 cents times 6,200 is 2,480, times 7,200 is 2,880 all the way across. Same with maintenance, 20 cents per hour. So you end up with total variable overhead costs. Then we can then aggregate this direction, get 92.4 for variable, 154 for fixed, gives us 246.4 for total overhead costs. Manufacturing overhead based upon the information that are given, okay? And then one final piece, which I think is kind of interesting, and I would have kind of liked to have taken this and divided it by variable and fixed, broken it into 2 different pieces. But what they've done here really is sort of taken total overhead costs, both fixed and variable, 246.4 divided by total labor hours, which is the driver, and arrived at a overhead cost per unit of $8 per hour. And I would have liked it had they broken this into 2 different pieces, and you would have the fixed cost be somewhat greater per unit than the variable cost. But nonetheless, it's important to know how much of a product cost is absorbing overhead that is applied in some reasonable, rational fashion to units of output. That's important. It's important from a costing rationale and that sort of perspective. Okay. All right. We're running a little bit low on time, but I think we can. I'm probably not going to go too far into this because we're sort of entering a new category here, and that is we've left product cost. All right. Let me go back, flip all the way back here to this slide that I really like a lot because I think it's so helpful. We are sort of leaving the realm of product cost. We have a sales budget where we're going to produce X number of units and attach a price to those in a dollar figure. And so it's expressed dollar-wise. Production budget is more of a quantitative, a numerical issue, which then we got into direct materials, which we just covered, direct labor, which we just covered, and which we just now covered, manufacturing overhead. Okay. So these are if you want to look at it from an income statement standpoint, we have sales minus cost of goods sold. Gives us some sort of gross profit. I know I'm sort of inferring an invisible income statement here, but that's the logical flow. We are trying to build an income statement, okay? We can't do it. It's a projection, what we call pro forma. We're projecting an income statement. We don't know what it's going to be. This is what we think it's going to be. Remember, an income statement we produce for the general public is historical. It's what's happened. It's done. This is going forward. This way budgeting is really the opposite of reporting, is we're projecting forward. So, okay. So we got sales minus cost of goods sold equals gross profit. Now we go to operating expenses, which are sort of this big catch-all called selling and administrative expense. And sometimes this particular category is a gigantic category, and it covers all kinds of things. And just real briefly, because I know we're almost out of time, when we are talking about the selling administrative expenses, what are we really talking about here? Well, we're talking about things like salaries of staff personnel, not line personnel. And we go back to I think week 2 or week 1 even, where we differentiate between line personnel, those who are involved in producing the product or serving the customer, whatever the business is involved in doing, and those people which support those people, like HR and IT and legal and accounting and all those areas, research, all those kind of areas. And those costs are mostly fixed because they're mostly salaried, and labor is a big component of that. Labor is a very big component of that, but these are period costs, not product costs. We can't take these costs and put them into the product costs themselves. Okay, so this is a pretty good segue for the next area where we're going to go. We're going to produce a sales and selling administrative budget, which we sometimes call general administrative expenses, or G&A, all kinds of different words for what are really period costs. And so we're going to build that beginning on Monday. And then the next piece is simply to build what we call the pro forma, or projected income statement. From there, once we know what that looks like, then we know what resources we need, asset liability wise, in order for us to do it. And then we'll get into the financial budgeting, and that'll be the very last piece of it. And then next Wednesday, hopefully we'll have time to do some example problems and exercises. Okay. And again, the due date for the chapter 15 activities are the 24th. So you can start whenever you like, but they're not due until a week from this Sunday. So it gives you some time to look it over, and we will talk some more next week. Okay. Any questions before we wrap this up? All right. Have a good weekend. See you next time.